We're about to start an interview with Raul and Richardo. He's going to be talking about how we're going to position in this economy. You want to know how we got there and what's happening going forward. You really want to take a listen to this one. Silence on set.
We're here with Richardo Williams, and he is Head of Investment Research and Strategy at Barita Investments. So, Richardo, welcome.
Yeah, man, thank you, Rob.
Right? So, Richardo is a perfect example of the Barita BrainTrust personified. Yeah, but I'm very happy to have you. So,
thank you.
All right, so, I mean, what we're trying to do here, we always seek to improve our clients' relationship with their money, right? And we just want to add insights, and we're going to have this conversation around the economy, right? So we can start out very simple. What is the economy?
The economy is what you can consider to be, in very simple terms, it's almost like a machine, right? Which helps to allocate resources, right? Ensure that people who want things can get it in exchange for money. That is, the persons who are producing will get money in exchange for that. So in very simple terms, it's a means of exchange, and there are different moving parts that go into it. But at the core, right, an economy represents a machine, essentially, a mechanism to facilitate the exchange for demand for goods and services, essentially.
Okay, great. So as far as the Jamaican economy, at this moment in time, having been through the start of the COVID pandemic's direct hits in March, and we're here filming in June, how do you see the economy? How has it performed, and what is your general outlook?
Well, first of all, just to answer the question behind your question, really is what is happening, and how do we feel about it, right? The way I would say it is that we are experiencing what the planning analysts call a wicked problem.
That's a technical term?
Well, yes. And I suppose they just couldn't find anything else. This is a wicked problem. Because it is characterized by what we call extreme incomplete information. Whereas they don't know what the hell is going on. That is why you saw the market sold off in March 23rd to be exact. Pretty much all the markets around the world pretty much tanked. And basically, people don't know this is a pandemic. Economies are shutting down. We don't know if people are going to die. We don't know what the morbidity is going to be. That is, if you survive, what will be the effects. So when you are uncertain, it is almost a biological instinct to seek safety. And even safe assets weren't necessarily safe at that time, right? So how do I feel now, right? We feel a little bit better, right? Because we have moved from what are called unknown unknowns, that is, you don't know what you don't know, to a state where we know what we don't know. What exactly we don't know. The economies are beginning to reopen now, right? So we don't know exactly whether there will be a resurgence in new infections. We don't know, for instance, those who have survived, whether they are going to start showing up new symptoms, as one research that we have seen thus far is suggesting that there could be some blood clotting issues going on. Will that develop further, right? So that are some, that represents some uncertainties that remain. But globally, central banks and governments, that is on the fiscal policy side of things, have done a phenomenal job. The word that you will hear being bandied about every day is unprecedented. Unprecedented monetary policy, unprecedented fiscal policy. Because governments have realized and have agreed pretty quickly that this is a medical crisis, right, which have led to a financial, well, not a financial, but an economic crisis, right, and they have responded accordingly. So we feel a little bit more, we feel a little bit better now that we're seeing the green shoots in the real economy. And by the real economy, we mean people are starting to go back to work, people are starting to eat out again. A good example of that is Open Table. And Open Table basically collects data on the number of persons who are going out to eat, the diners. Germany is basically back to the pre-crisis level, meaning that in terms of dining, right? So those are things that you look for and say, yes, in our industry, we call that well, a bottom is forming, meaning that, you know, the economy is probably poised to start to inflect upwards again. We also have what we call the ISM, or the PMIs rather, which is Purchasing Managers Indices. And these are the guys who are on the ground, you know, looking at real demand for goods and services. And there's a kind of expectations. Those have started to bounce back up, again, based on the data that we're seeing. So that gives us a bit of confidence that, yes, the fiscal and monetary policy measures are working, and it is consistent with previous financial crises. Because another term that we use in the industry is that the recovery is always going to climb a wall of worry, right? So people are always going to be worried on here. 30 million persons are unemployed. You know, how can the stock market be at such high levels? You know, something is wrong. You're still going to be some hesitance. If you're an investor, you're going to say, all right, I'm keeping my cash, or I'm keeping a near cash investment or so. But if you look closely at those data that are very in tune with what is going on in the real economy, we're becoming a little bit more confident.
Okay. All right, so you said a lot, right? So, I mean, start out just showing the power of the BrainTrust, because, I mean, it's so powerful. You never answer my question first. You go to the question behind the question, right? So, so referencing March 23rd. First of all, how bad was it?
It was horrible, because, you know, we actually thought that we were going to go back to the Great Depression, just in terms of the rate at which assets sold off. Just to give you an idea so that people can anchor on. If you use the US 10-year Treasury yield as a kind of benchmark, previous periods of economic distress, persons usually run to that. You know, it's just like in ordinary life, when you're in trouble, you run to your mother. US 10 years is your mother in this instance. And not even your mother you wanted to go to in this particular case, you know? Yeah, wow. So people, in this case, we had what we call almost a perfect correlation of almost every asset. Right, people were selling off even U.S. treasuries because they were so fearful. So it was that horrible, right?
And that's unprecedented.
That's unprecedented. That's really unprecedented. And this was right around the world. Even our local JSC, all the indices fell as well.
Like what kind of fall are you talking about? You put a number.
You know, well, I think it was more than about 30%. It was 30%, something, I don't remember the exact amount, but it was north of 30% for the JSC. Yes. The same thing for the S&P. So S&P, the NASDAQ, all of them tanked.
So to put that in perspective,
double digits.
So that's 30% from peak.
From right. So it would have been from January.
From January to March, it was 30%.
Right. So it fell pretty much precipitously.
Okay, so if we can just stitch it together. First of all, 70% of the US economy, that's about $14 trillion, right? So giant number.
Yeah.
Okay, so from where thus far, we agreed that describing how bad it was as crystallized in the March 23 market movement, you're talking about 30+% move down in markets, both locally and in the US, right? So those are Great Depression type movements. That's how we kind of describe it.
Well, somewhat.
Okay, so the point is it was very bad because in a quarter it did what we did for a whole year almost in financial crisis. All right, so come to unemployment. Unemployment definitely behaved worse, right? And that is threatening Great Depression like numbers, correct? If we talk about US unemployment.
Right.
So landing it to where we are now in the discussion, based on what President Bullard of the Federal Reserve mentioned, it sounds like he's fairly sanguine that the central government's response in the US will be able to tide those unemployed and furloughed workers over for the short term, right? Okay, so where does that leave us, and parlay that to the Jamaican economy for us, right?
No, that's an interesting idea, at least from the perspective of Jamaica, right? Because we are trying the very same thing,
okay,
right? The combined fiscal stimulus that we are looking at is about 25 billion, right? When you take into consideration, right, 25 billion Jamaican dollars, and every Jamaican, can say, this is unprecedented. I've never gotten back money from the Jamaican government, and it is testament to the bitter medicine that we have been taking over these past years, with the fiscal reform, the stringent primary surplus, that we have had to meet 7.5. We brought it down to 6.5. So those built up our capacity to kind of absorb a shock like this. So having said that, we have been providing, and by we I mean the Jamaican government, we've been providing a range of, have initiated a raft of measures to help those persons, especially in the tourism space, who have been unemployed or temporarily laid off, right? They have actually expanded that to include persons who the corner shop and who does barbering or hairdressing and so forth. The idea is that you want to ensure that during the period of the economic lockdown and curtailment, these persons can still consume. They can, at least at a basic level, maintain some degree of consumption for themselves and their families. It therefore helps in a swifter recovery thereafter. But ultimately, it depends on how clinical we are in executing the reopening of the economy. To the extent that we do not have, new infections arising, from persons coming in, or even community spread, then it enhances the likelihood of us actually making a swifter recovery. And I want to just put that idea of recovery in three broad ways or broad themes, just people can have something to latch on to. When the COVID came on at first, we thought about 3 Ds, how you can think about it. You can think about the depth, that is how deep the impact will be. By now we can agree that it has been very, very deep.
Yes.
We're talking about the duration, how long it will take us to get out of this. And there's a third D, which is very, very important because it impacts on the second, is the dispersion, meaning how widely spread are the effects throughout the economy, right? The dispersion obviously is dependent on how quickly, and successfully we can contain the spread of the virus once we reopen. If we do that, let's say, in our best case scenario, we do that successfully. People can go out, do their business as they usually do. Then the dispersion will be limited, and therefore the recovery will be that much sharper, right? We are aiming for the same thing locally, right? And that, I believe, is the biggest uncertainty right now. As new June up to June 15th, what we have local persons coming in thereafter, we can get international visitors. So let's say by June 30th.
I think it's open to citizens now, and then the tourists come on the 15th.
On the 15th, right. So say 2 weeks thereafter, or 3, whatever the case is, you want to be actively looking at those numbers in terms of whether there are new cases and those kind of things, because the implications are grave. Meaning, if we have God forbid, a community spread, then you're thinking about an already frail healthcare system, to now be, burdened with new cases and so forth. It might require a new set of lockdown or curtailment measures, and therefore the economic recovery will actually be drawn out, right? So we can think about the recovery in those broad themes, and therefore come up with different scenarios. But our working hypothesis is that we can at least successfully contain any new, infections. And I think the Prime Minister and the Minister of Health have said it, albeit indirectly, that, we just have to live with this thing. Just their way of saying, boy, new people, new persons are going to get the infections, but we just have to cope, right? That kind of gives you an idea that the recovery is going to be one that we have to grind out, basically. It's not going to be a sharp recovery, certainly. So
in your base case scenario, the country gradually gets back to where we were? It takes some time. So you're not forecasting a V? No. Certainly not in the case of Jamaica. Because the truth is, in 2013, right, when we started the last round of the IMF programs, we were in a horrible place, right, on the fiscal front, meaning that our debt to GDP ratio was a little bit under 150%, right? When the 2007-2009 financial crisis struck, we were at about 139% debt to GDP ratio. Our net international reserves were under about 500 million or so. If you contrast that to now, our debt to GDP is about 90 now. Record NIR, we have about 3 billion or so in reserves. So we have a little bit more capacity, I think, to absorb the shock, right? That is our ability, our capacity to rebound. But there are still limitations. 90% debt to GDP is still a large number, right? So it limits your capacity to rebound as strongly as an economy such as the US. But we should rebound. So the base case is a kind of grind. A grind. Okay, I got it. And then, so what are the risks around that? Like, what could make it be an L in terms of us not recovering anytime soon, and what could make it a V? Well, the L, and I would, there should be some wood here, knock on wood, we don't get a tropical storm, a hurricane, or anything, anything like that. As I jokingly said to you earlier, that the way 2020 is running, perhaps the base case should be that it's even some strong breeze you're going to get, The last time I heard that there are some asteroids heading near to Earth, wow. But if we should have some kind of cyclonic activity, a hurricane, a tropical storm, that certainly could lead us to a L. And what the L means is that, boy, we're just in a very bad place. We could have unemployment numbers remaining elevated. The number of persons below the poverty line
could actually expand. And that's also something that we have to be mindful of, because leading up to the global financial crisis, the number of persons below the poverty line in terms of percentage was just under 10%. That expanded to almost 20% thereafter. We brought it down slightly to about 19 based on the last numbers that I saw.
That's the poverty rate?
Yeah, one persons below the poverty line population.
But if I listen to the finance minister, he says the latest figure was based on 2017 data. Is that
yes,
right?
but right, because that's the latest
Legal
data
line.
we have. So that's why I say based on the number. So yeah, that's an aside. We need data in this country, you know.
I mean, I guess it's reasonable to expect. I mean, it was 100,000 jobs created over the last 4 years. So given record unemployment, one would guess or guesstimate that the poverty rate would have come down.
Yeah, man, but I don't think it's
more in 2020.
But I don't think it's you know, let's not speculate. But what we can definitely say or be reasonably sure about is that the number, that is the numbers below the poverty line, may have increased based on this.
What's happened?
This right.
And then in an L situation,
it
gets even worse.
That it gets even worse. And that's important because a raft of ramifications can flow from that. Again, the numbers show that probably about 50% of the individuals below the poverty line are actually children. So that brings into question issues of abuse and a number of social issues and ills that come out of that. Possibly an increase in opportunistic crimes, such as robberies, violent crimes, and that kind of thing. So an L scenario is pretty bad. And a V obviously is that we do much better than we currently expect, meaning that people start to travel much quicker and in larger numbers than we currently anticipate. One estimate I've seen thus far suggests that for this tourism season, we probably have about half our usual numbers. It could be less because cruise contributes about 40% of the total pie, and they have been.
They have a no-sale order in the US.
Right, so we know how that goes. So let's say that we have more numbers on the tourism side than we're currently expecting. We keep whatever new infections arise, we can control it, and local confidence remains intact, both on the consumption side, meaning persons are willing to still consume and buy into durables, still build their houses, buy their cars, stock up in the furnitures and so forth, and businesses still pursue their capex, their capital expenditures. They still decide to build new warehouses, build new factories, etc. To the extent that those continue, then it enhances our ability to actually approximate a V. See who will be a V.
So there was some data that was published by one of the cruise booking sites. It's very anecdotal, but I think they had shown 200%
year over year.
Increase year over year. So I imagine, so cruise has gone to zero, essentially, right? So I imagine if those kind of numbers apply more broadly, and the no sale order is lifted in July from the American Center for Disease Control. If we get a vigorous cruise response, you think that would be a big part of any kind of V scenario?
It could.
Okay.
And I mean,
and pent up demand
because that's really where I was heading as well. I am not strictly like a quantitative analyst, right? I believe quants play their role, but it's very important to also factor into your analysis the human nature, right? After you have been locked down in about 3 months or so, right? boss, as they say, you are going to want to consume. And we saw an example of that in China. The Hermes store sold out in one day, their best possible sale in all their history.
Wow.
Right? Immediately after China, decided to reopen. Persons were under lockdown. I can't see my friends, I can't see my family. I'm now free. Hey, let's buy a Hermes. Persons will say, okay, I'm going on a cruise. I might.
The Jamaica.
Yeah,
it's cold.
it's human nature, and the way you think about the nature of COVID, it's not like something like even Ebola or so, where the mortality is high, and you possibly knew somebody who died from it. In your consciousness, you're saying, okay, persons get this thing, they probably go get some medication, have been quarantined for a week, and they recover. It is not to trivialize COVID-19, but it is just to kind of get an insight into how human nature is, and therefore how you can possibly manage it also from a public policy point of view. Because as you walk around, even here, going for lunch or so forth, what I realize is that in the first week or so after COVID, we said that we should be wearing a mask. I saw a high level of compliance everywhere persons are. But the more that the thing goes on, you start seeing fewer persons wearing it. You also have to factor in our culture as well. We are give me a blind our culture. You jump out of your car, you forget your mask in your car, and it's just security. Well, I may just pick up some here, so just let me eat. Those, you factor those things in, and when you aggregate them, these can pose a kind of risk to our recovery, right? Those cultural and human behavioral
risk on both
things.
sides.
Yeah, man.
Hey, listen, the first week of the quarantine, being home, Richardo, I had gotten to the point where I was convinced the walls are going to close.
Yeah, man. Yes.
Like they were going to kill me, right? I mean,
Exactly.
so for me, I definitely experienced personally that kind of pent up demand. I mean, the minute you let me go, I'm going to go and buy a lot of bread, right? But so we want to look at those scenarios and what they mean for the economy and markets. But before we do that, pre-COVID, would you describe the economy as strong, stable, or weak?
Strong. I mean, if you use the stock market as just as an indicator of sentiment and expectations, the stock market was piping hot. You're seeing young persons very active on Twitter, getting in on the action, posting their dividend checks and so forth. So persons were actively getting in. I suppose those are the laggards. They're just coming into things. So if COVID had not happened, I anticipate that we would have continued like that, at least locally, right? Because the fundamentals supported it, right? Absent COVID and positive, we would have gone on to reduce our debt to GDP numbers as we had budgeted. We were actually running ahead. That is the fiscal measures in terms of tax revenues, right? The ones that are coming in. But also,
the stock market contributed to that in no small measure as well.
In terms of
added revenues to the government because of IPOs.
But mainly it was like from GCT returns and so forth when you look at the fiscal tables, so forth. So, which means transaction, definitely in the real economy. When you're seeing taxation at that level, it means that people are doing things.
So for those that say the headline growth was 0.6% in terms of GDP, I mean, how do you reconcile that with your view of strong economy?
What we are seeing is, and the stock market is a very good example of this as well. If you look at the the companies that are doing very well are mainly financial companies, right? So you can have financial companies or the finance aspect of the economy, the financial economy, doing well without the real economy necessarily lagging, right? So that's one possible explanation. It could make sense because if you even look at agriculture, for instance, if you take like a quarterly time series of our quarterly GDP, you realize that generally the quarterly GDP number goes in the same direction that agriculture is going. So agriculture is going down, quarterly GDP is going down, and so forth. But that era is begging for innovation. It's begging for proper attention, pretty larceny and so forth. The transactions costs there are just too high. So I believe the real economy, there are still a lot of what I would call structural impediments. If you think even about exporting, for instance, I saw the head of the Jamaica Manufacturers and Exporters Association, so Pandu tweeting recently that to even export, there is a customs administration fee. In other words, you have to pay a fee to export. So you have things like those that I would call, it's like you trying, imagine Usain Bolt on a track runner, you have this balloon behind him, pulling him back. Because I really think the power in the Jamaican economy, in terms of the resources that we have, the innovativeness of our people, the management competence that we have right across the corporate industries, we can, I believe, grow north of 4 or 5% once we solve for these things. Crime, again, is a serious impediment, right? The way I think about it sometimes is that just to bring this idea home, have you ever considered that Jamaica really runs on just a half its capacity? Because between 6 a.m. to 6 p.m. is when we do things. Between 6 p.m. to 6 a.m. the economy is pretty much shut, right? Outside of entertainment and things, but why can't factories continue to grow like that? And I can give you an idea of why that is so. Although it is anecdotal, I read about a manufacturer of spices, in Westmoreland, and they had done some recent, rejigging to, improve their capacity. And what the guy was saying is that the problem that they're having, let's say that they have the capacity to run 2 shifts, they can only run 1 because by 6 p.m. everybody wants to leave because they have to go back into their communities, and they fear for their lives, crime and that kind of thing. So we have to solve for that. So just kind of bring it back to the idea of why we're having a point or not something growth. Those, I believe, are the structural impediments. But there are also measurement issues as well.
And then even with all of that, we had pockets of strong growth, because I didn't mention before, tourism was strong pre-COVID, and rip-roaring stock market. So just imagine if we correct some of those structural issues, what we can do.
And I'm happy you touched on tourism as well, because for the longest time, we have been talking about what we call the intersectoral linkages between, tourism and other sectors, such as the most likely ones are manufacturing and agriculture. So there are initiatives underway to get those done. Why is that important? Because tourism is a huge consumer, as you can imagine, of food products, agro-processing products. So to the extent that we can get more of our local farmers selling to the hotels, to the extent that we can get more of our local farmers supplying the agro-processors, so they can and export and so forth. Once we build those intersections out, then we can actually see more growth going forward.
So, all right, so you have your base case of grinding out a recovery, right? And then we have the L risk, we have the V risk. So in light of all of that, what do you think investors should do?
If you are an investor, it's akin to you making a conscious decision to move from point A to point B, right? Now, no matter what the conditions are, between those 2 endpoints, your intention is to move right? Your intention is not to remain stationary. So obviously, the vehicle becomes important. What takes you from point A to point B. We're saying whatever vehicle you decide on should have certain characteristics. Should they have very good shocks, very good tires, very capable drivers, assuming you're a chauffeur, of course, right? So in practical terms, what that means is that you want to invest, if you're doing equities, invest in companies with very strong balance sheets. Those are the shocks, the tires on the car, And why that is important? Because when you have a strong balance sheet, and by a strong balance sheet, we mean you have probably high equity relative to debt. It means you have the capacity to absorb shocks such as this, right? It's like your rainy day fund, basically, a little thing not on the mattress, but a cornerstone merchant. Something happens, you can't just pull on it, right? But you need to have a strong balance sheet. You also need to invest in companies that have exhibited strong and capable leadership, right? What that means is that, stability, there has been stability in leadership. In other words, you don't see the leaders changing every 2 years or, and so forth. There's consistency. And they have had a track record of delivering strong returns to investors or on investors' capital. You also want to invest in companies that are positioned in industries or sectors that could be, that could benefit in a period such as this. And I mean, maybe as an example, you could use it. Think about like an express catering, right? During the period of the lockdown, they would have had, almost little to zero business because the airport flows were very small. But now that the economy is reopening, persons are anticipated to start flying again. You would see their numbers begin to improve. So to the extent that a stock such as that was sold off, you would want to probably get into a deal such as that. You also want to look at companies that have geographical diversification or revenue diversification. They are not solely dependent on one source of revenue, right? That could mean different things. It could be like a portfolio company where you have, let's Panjam just for argument's sake. They have a percentage ownership in Sagicor, but they have equity investments in other companies and so forth. They did take a hit recently in their
market exposure,
but it's unrealized. But then again, they have exhibited strong leadership over the years and have demonstrated a very good ability to return, decent investments on investors' capital. So you need to take a long-term view on a company such as that and decide whether at this stage you're getting it at a good value. On the bonds or fixed income side, there you want to look at, if you're looking at sovereign bonds, you really want to look at countries that have very strong fiscal shops, right? Meaning they have limited debt to GDP ratio. The recommended level of debt to GDP ratio is about 60% or so. Right? So you can use it as a benchmark. Jamaica is probably an outlier because people are always demanding the Germans, and it's because we have a very, 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 very excellent tradition of servicing and paying our debts, right? So persons are always going to want Germans. So outside of Jamaica, you want to look at other economies that are pretty strong and where the yields are trading either relative to their peers, that is other countries of a similar structure, or historically where the yields are relative to where they normally trade, right? Because there are still some opportunities that exist because during the sell-off in March, even very good credits were sold off, right? And they have not necessarily normalized just yet. So you can look for opportunities in that space as well. And the same goes for like if you're investing in corporate bonds, you really want to invest in very strong companies with very good balance sheets as well, not too much debt in the structure relative to their equity and their earnings potential.
Okay, so if you wanted to leave viewers with a closing message on the economy and markets, what would that be?
Remain invested. Of course, remain invested and take opportunities as they come. This is really an unprecedented, well, I shouldn't say unprecedented, but these opportunities don't come always. So you can get very good assets at decent prices now, but you have to play the long game. The recovery will be akin to climbing a wall of worry. So you have to be able to tune out the headline news, so to speak, and consult, licensed, very good investment advisors, hopefully at Barita.
All right, Richardo, thanks a lot for coming. Yeah, man. Bless it.